Wonderful. Thank you very much, Bethany. Well, thank you everybody for being here today. This all started with questions that we received from you. So today we're going to talk about keeping market volatility in perspective. And like I said, the driver here was questions and comments that we heard from the families and individuals that we serve. So we're pleased to be able to bring this your way. And with that, we'll get started. We're gonna do some introductions. So I'll be saving the suspense. My name is Thomas Pargett, and I am the facilitator of the presentation today. I'm gonna do very, very little talking once introductions are over, so that should please everybody in the audience. The brain power is really gonna come from Derek and David. And with that, we have Derek Hoyt, our Chief Investment Officer, who is stationed in our Bloomington, Minnesota office, which is our headquarters right outside of Minneapolis. And we have David Payton, our portfolio manager, who is stationed in the Waterloo, Iowa office. So gentlemen, thank you for being here.
Thanks for having us, Thomas.
Yep, happy to be here, Thomas.
All right, so today we're gonna do a couple of things. The theme of this presentation is just like it sounds. It's historic market volatility, and we're gonna add a flavor of perspective. So the first couple slides are gonna deal in different scales. There's gonna be a daily scale, an annual scale, and a decade scale, and then we're gonna build on it from there. We're also gonna drill down on some vocabulary words and some terms that people often hear, and it's thrown around very, very loosely in the financial news and the financial industry. It's my experience that those are thrown around so loosely and so casually. Not everybody truly knows the background there. So we're going to go into those to really make sure there's an understanding of a lot of the terms that deal with volatility, and to give some of that perspective. Our objectives today is to have the audience, you, understand volatility. We're hoping at the end of this, you'll embrace the fact that volatility in a publicly traded market is very, very normal, and it's something that we should come to expect. I mean, we all know how crazy it can be to watch those movements on a literally a second by second, minimum minute to minute basis, but that is the publicly traded markets that we're dealing with. So to bring some awareness around volatility and that perspective, and to create a familiarity of some of the common financial and economic terms. At the end of this, we'll go through really a baseline forward-looking expectation of that our team believes in. And then we'll have some opportunity for questions and answers. So we'll get rolling. All right, so David, let's start with you. A normal day for the Standard & Poor's 500, S&P 500, we've got some green arrows, we've got some red arrows. First off, can you just define for the audience legitimately what is the S&P 500? That's a term that's thrown around a lot. Can you tell us what that is, and can you walk us through these green and red arrows?
Absolutely, Thomas, thank you. So the S&P 500 is essentially the basket of the largest stocks on US stock exchanges. And it's used basically as a proxy or a device for investors to track market movements in aggregate. And the S&P 500 is in the same, the Dow is the same way. It's another basket of goods, or the NASDAQ is another, or goods, stocks. It's another basket of stocks that is used to track the market. And so a lot of our data today will be focused on the S&P 500. And yeah, so to start, I thought it'd be good to define some baseline expectations for equity markets on a day-to-day basis as a way to describe how markets act. And so the arrows on the left side here describe what we're considering a normal day for the S&P 500. And so since 1950, we can see that 80% of market days essentially lie within a 2% range, up or down 1%. But I think what's more interesting is that the probability of markets being up or down in a single day is nearly the same as a coin flip. So day-to-day movements are very hard to predict, if not impossible, and short-term investment strategies are very difficult. And that's why us here at Bergen KDV, our investment philosophy and strategies use a long-term perspective.
For the day traders out there, I mean, history shows us it's basically a coin flip on a day-to-day basis if it's going to be up or down, right?
Yep.
Fascinating. So there's our day. So we started off the first 3: day, year, decade. There's our day. Let's go into daily volatility expectations in a year. So David, walk us through what this means and how we can utilize this information.
Yeah, of course. So obviously the concern for investors then lies with outside of this up or down 1% range, specifically movements to the downside. And while these are less common, we should still expect to see these year in and year out. Out of more than 18,000 trading days since 1950, more than 400 of them have been negative movements of 2% or more. So if we use this percentage, we can estimate that on average, we might see 5 to 6 of these days within a year. Now, that's not a guarantee. Some years we may see more, some years we may see less. But on average, you can probably expect 5 to 6 days within a year that are down 2% or more. And the one thing I want to add is these days do tend to group together. So if you see 1, you might see 2, 3, 4, 5, etc. And so you may go along a decent period without seeing some of them, and then some of them group together. But on average, 5 to 6 in a year. And so these are the days that really they rattle investors. They can cause people to panic, and they may lead investors to make reactive decisions, which is something we advise against.
That's a great point, and I'm glad that you talked about how they can group together, because that's when it feels like the world's falling apart. Is if we can reasonably assume based off of the data that there's about 6 per year of daily market movements of -2 or more, you might get 2 or 3 in a row and feel like the world's falling apart. But in reality, if we look at the whole year, that's actually fairly expected, at least from the data that we have. And then you could also, it's rare, it's not impossible, but it's rare that you'd have a 5% or more, and that would really feel hard to swallow. But the data shows us that's going to happen probably on a yearly basis. So really good information. Yeah, so you throw that in with a daily up and down of the coin flip, and you just put a couple days together, and it can be hard to swallow for sure. So we take that from daily volatility expectations over a year period, and then we go into this one, which is really one of my favorites from a market timing perspective. And we're looking at 2 decades here. So David, walk us through how trying to time the market perfectly can actually be really costly.
Yeah, and so this slide is showing why we advise against reactive decisions. As shown on the chart, missing just a few crucial days over a 20-year period can significantly diminish your returns. As we often tell clients, getting out of the market is not one decision, it's 2. It's when to get out, when to get back in. And many times, some of the best days in the market quickly follow some of the worst days. In fact, the single best day for the S&P 500 since 2008 was the day immediately following the very bottom of the market drop in March of 2020. And so an investor who may have gotten out of the market at that time would have lost out on the immediate 9 to 10% that we saw on that day following the bottom, as well as the value lost throughout compounded future returns. And so you can see missing just 5 days in this 20-year period, assuming you had $250,000 invested, would have cost you $500,000. And one of my favorite sayings that I tell my family often when they ask me for advice, I say, it's not about timing the market, it's about time in the market.
Yeah, so this is such a good visual and something I'll be keeping for many, many instances. But essentially, if you had tried to perfectly time the investment of $250,000 over a 20-year period, and you ended up missing the 15 best days of the market in that 20-year period, you can see on the far left, the total return if you had just been invested 100% the whole time, your money would be worth $1.3 million. And on the far right, if you had missed the 15 best days because you were trying to get it perfect, your money would be worth $470,000. Well, that's just a little bit less than $1 million that you missed out on because of 15 days. That's a gigantic whiff, basically, by just trying to get it perfect. Really good data. Okay, so David, walk us through now this this is a 42-year chart, and we've got some green and we've got some red dots. Help us understand what this means.
Yeah, so let's expand beyond daily movements and turn our attention to longer time periods. So as we look year to year, basically what this chart is showing is corrections or drawdowns in the market are a regular aspect of functioning markets, and they by no means prevent positive returns in a calendar year. I think one of the best examples of this is very recently in 2020. The market dropped nearly 34% in March of 2020 and went on to return 18.4% for that year. Declines within a year over this 42-year time span have averaged 14%, and despite these declines, the S&P has returned on average 13.6% in a calendar year, with 83% of those years being positive returns.
So something I like to tell the individuals that I sit with is, right, wrong, or indifferent, we've gotten, our memories are short, right? The human memory is very short. Since April 1st, basically 2 years ago today, April 1st, 2020 to basically January of this year, so 18 months, give or take, we saw nothing but up because the market bottomed in mid-March of 2020, and then it ended up 18.4% for the year. And then last year, we only saw a 5% drawdown in the S&P 500, and it ended up 28% up for the year. So you put all that together, and we've had a fairly, it's a short time frame in the long term, we've had a really good run the last 16 to 18 months. And now we've seen a drawback this year, and it seemed very painful, when in reality, if you look at that, there's a whole lot of red there. I mean, it's normal for the markets to draw down. Is that a fair assumption or a fair assessment, David?
Absolutely.
Yeah. Okay, so let's then jump into the current drawdown, what we've seen, and walk us through what this chart says, when it was last updated, David, and really what this means for current day over the past couple of years.
Yeah, so this is data as of yesterday's market close for the S&P 500. The current sell-off that we did experience, or kind of in the middle of experiencing, did hit 13%. Is on the far right there is the bottom of the V. Since then, we've seen a decent week or two here, a bit of a rebound. The market's off, including today, somewhere between 3 to 4%. So by historical standards, the bottom of that drawdown that we saw, 13%, is actually quite average compared to those 42 years that was shown on the previous slide. And the current 3 to 4% off the high that we're seeing right now is fairly mild.
So I'm gonna track back here for the audience real quick. So we hit, David, remind me, you said 13% was so far our bottom this year, right, give or take?
Yep.
So if we go back, whoops. Okay, if we go back here, 13%, just like David had noted, is really relatively common. We saw 33% in 2020, almost 20% in 2018, the 9, the 12, the 9, the 19, the 16, the 27, the 48% drawdown. So it's really, as of this moment, at this point in the year, it's really right on par with what we've seen traditionally. Fair assessment, David?
Yep.
Awesome. Okay, so I like this one a lot too. This is really going to talk about the occurrence of volatility and how it's somewhat been fairly mild as of recently. So before we get into this, there's a word here. It's one of those terms that I mentioned earlier at the beginning that I know is thrown around often, and I know not everybody can completely understand what that means. So I'd like you to give us two definitions first, and Derek, feel free to weigh in with color if you'd like. What's a correction and what's a bear market? Are they the same? Are they different? Those things get thrown around all the time, and I field a lot of questions around those two. Can you educate the audience?
Yeah, and I'm not sure I'll be able to give you the exact technical definition, so I'll kind of give you my somewhat of my nuanced opinion, I guess, of how I differentiate the two. Personally, I think of a correction as faster. It's a quicker drawdown on the market of can be 10%, it can be 20%. Based on some uncertainties surrounding things such as we're experiencing geopolitical issues, and sometimes this is usually accompanied by a fairly quick rebound in markets. And then a bear market, I tend to think of as maybe a little slower moving and can be driven by a deterioration in actual underlying fundamentals. So think earnings of the companies, maybe a deterioration in earnings of the companies that make up the S&P 500 or whatever market it is. And then a recovery from the bottom, might be a little slower. That's not to say that it has to be slower, but that's kind of how I view the two, a correction versus a bear market. I think of corrections as being faster.
Yeah, I would agree. I think that's a subtlety that's lost on people sometimes. When even if you look back to I think it's the previous chart in 2020, we had a quote bear market. The technical term, I believe, for bear market is just any decline that breaches the drawdown of 20%, and we breached that. It was 33% drawdown in 2020. Technically a bear market, but in my mind it wasn't. It was, we had that whole drawdown took, I believe it was 3 weeks. And that to me is not a bear market, as David's point, a slow grind down. It weighs on you psychologically. It's not a buy the dip moment, which is basically what we ended up seeing in most of these recent examples. So I'm not a fan of the technical definition of a bear market, but
so is it? Yeah, it's fair, and it's fair to say it's fairly subjective, right? I mean, obviously there are technical definitions, but at the same time, they both seem to act differently or they behave differently, and that technically was a bear market, but it was so quick it could be classified as a correction. Is that accurate? Yeah,
I would agree with that. Yeah.
Okay, interesting, very good. All right, so we got that. Corrections, bear markets, they are different, but they are rather subjective. They both mean decreases in the stock market in some capacity. But so let's stick on corrections here. David, walk us through what this data says, because it's going to lead us into our next slide, specifically around why it hasn't been as common, or we may assume. So go ahead, David.
Yeah. So the visual here is kind of showing over the past decade, corrections have occurred less often, and they've been less severe. So that bottom row there, the decade from 2012 to 2021, the average correction was 11.3%, and we saw years with a correction of 10% or more 3 times, so 30% of those years. And so the time between those corrections, the average time, more than 3 years. If you look at the middle row there, it's almost a not complete opposite, but it's a different picture in the decade preceding that one. From 2002 to 2011, the average correction was almost 20%, and we saw that in 70% of years. And the average time between corrections was less than half of what we've recently experienced, and that's more than the 42 years from 1980 to 2022, and the most recent 10 years is less. So we've kind of seen this dichotomy of more severe corrections in the decade preceding the current one, and then less severe in the most recent decade.
So we've had a lot of volatility since 1980, if you look at the data in that respect, but the last 10 years have been relatively mild, which does make a lot of sense, and we'll get into why that may be, but it's also big hindsight bias too, right? We haven't seen it, or recency bias, I should say. We just haven't seen it very recently. And then when we do feel the volatility come up again, it seems to be more painful, when in reality, it's really quite common since 1980. So Eric, I'm going to have you jump into the next one here. We saw this data here. We haven't seen a lot of volatility in the last decade plus. can you help us understand maybe what monetary and fiscal policy are and how that may have some relation?
Yeah, exactly. You're getting to the point of answering the question, well, why has the last decade been milder in terms of pullbacks? And in our view, a large part of that has been the extraordinarily accommodative monetary and fiscal policy that's been in place over that period of time, specifically over the last 2 or 3 years. And this slide that we're looking at right now does a good job of visually, presenting this dynamic. But before we get into talking about the chart specifically, to your point, it probably makes some sense to set the table with some definitions. So when we're talking about monetary policy, that just simply refers to how central banks, and specifically the Federal Reserve or the Fed here in the U.S., that's what we're going to be talking about. That's how the Fed influences the quantity of money and credit in the economy. The Fed's main goal is to regulate inflation and support employment as a dual mandate. And it does this primarily through setting policy on interest rates. And yeah, there are some other tools it has at its disposal. We've all heard about quantitative easing and reserve requirements and some of these other things that we're not really getting into those too much. But when we talk about the Fed and interest rates specifically, we're referring to what's called the Fed funds rate. And that's the interest rate that the Fed charges other banks to borrow money from discount windows on an overnight basis. Sometimes member banks or commercial banks, they have insufficient cash on hand to meet either lending or reserve needs, and they need to borrow it. So the rate that the rate that the Fed establishes, and the Fed fund rate, is very influential, and it's in essence the main interest rate that impacts a lot of other rates across the board, not only on the yield curve but to other bonds, loans, CDs, savings rates, all those sorts of things. And as a general proposition, the lower the Fed funds rate, the lower the interest rates on these other vehicles or securities are going to be. And Fed, we talk about accommodative Fed policy. Well, that's really what we define as when there are low interest rates and usually accompanied by an expanding money supply. And briefly to touch on money supply, the most commonly used definition of that in the U.S. is called M2, which is really the aggregate money in the economy defined as cash, checking accounts, savings accounts, money markets, certain CDs, things that are liquid. Right now, as you can see on the chart here, the M2 is approaching about $22 trillion. Fiscal policy, on the other hand, refers to the government's decisions related to taxing and spending. What's defined, accommodative policy here is defined by generally low tax rates and usually higher levels of spending. And that makes sense because one of the main inputs of certain GDP formula, gross domestic product formulas, is government expenditure. So the more a government spends, the more it supports economic growth. Again, at least according to certain formulas, it's just a mathematical reference. Bottom line here is that both monetary and fiscal policies are used to regulate economic activity. The more accommodative these policies are, in theory, the more supportive there is for economic growth. And this is where we kind of just get to the nuts and bolts of the chart. I mean, if you're looking at this, it correlates the U.S. money supply and the price of the S&P 500 index over the last 40 years. And we're not trying to confuse the high correlation here with causation necessarily, and we're not saying that an increase in the money supply over time is the only reason we've seen strong equity markets over the past decade, but it does demonstrate how institutional support has been a consistent backdrop to the picture. Because when the Federal Reserve suppresses the federal fund rates to very low levels, which it has, 9 in the last 14 years, the Fed funds rate's been basically at zero or zero bound, which is a little bit of a misnomer. It's actually defined as 0 to 0.25%. But that level of accommodation, it's a reduction in the cost of borrowing. It results in a reduction in the cost of borrowing, and that's just going to have effects. And adding to that, the Fed has done various episodes of quantitative easing, and I said I wasn't going to get too much into this, but that's basically where the Fed prints money and buys bonds that issued by the Treasury to keep longer-term interest rates down. And there's no question that these actions together amplify economic activity. Regarding the fiscal policy side of things, that's also been extremely accommodative since the beginning of 2020. The government spent almost $6 trillion related to COVID relief, much of that in the form of direct injections or payments to businesses and individuals. And all of this together has created a situation where people and businesses can borrow more easily. It fosters economic activity in terms of more jobs, higher incomes, greater levels of spending, and that leads to ultimately increased corporate profits and higher markets, which is, I think, one of the main points we want to emphasize here. We can't forget that the stock markets are fundamentally a function of how profitable businesses are, and those, or at least the businesses in those indexes. So, to conclude the point here, we've been in this period of, especially over the last couple of years, where the macro backdrop has been really extremely favorable to risk assets, specifically stocks. Conditions are changing now, and people recognize that inflation is increasing, and the Fed is moving to address it. They already have this month. So what once was a tailwind is not one any longer, and of course what's happening in Ukraine is, that's also a great source of uncertainty right now, but and which is another change. So I'll stop there.
No, it's perfect. So two really, really big important takeaways from that. Number one, thank you for defining the interest rate. It's a huge question mark. When the Federal Reserve, the Fed, raises interest rates, they're raising that interest rate between banks. That then influences the rest of the interest rate environment. It's a huge misnomer, something that's confused a lot. I talk with a lot of people. They hear that the Fed is going to raise rates, or did raise rates, or may raise rates, and what rate, right? and that's what rate it is. It's just one, but then that influences the rest of the interest rate environment. So thank you. Great point, Derek. Thank you. Second point, you said it. The market is made up of companies. If there's an environment where those companies can still be profitable, we should reasonably assume that they will be profitable over the long term. That's what the market is made up of. And we're going to get back to, or we're going to go forward to a slide that really hits home on some of the outside influences that may spook people. But ultimately, if McDonald's is still going to sell a lot of hamburgers and be very profitable, McDonald's should make money. Apple, iPhones, you get the story. Prime, I don't know anybody who's unsubscribing from Amazon Prime lately. So it's made up of the companies. Thank you. Great point. So while we're on the point of rates and rate hikes, walk us through what this means for the audience, pre-rate hike, post-rate hike, and what all the squiggles mean.
Yeah, I think, again, kind of before we get into that, I mean, in answering that question, I think it's important to first address why does the Fed want, or why would they want to increase interest rates anyway? Why would they prefer a tighter policy? And this goes back to the idea that they exist to regulate economic activity. And so in a normal business cycle, generally coming out of a slowdown, that typically the Fed will lower interest rates to spur economic growth. And if successful, often this growth, especially over longer periods of time, the economy starts to overheat, it starts to go too fast, and that causes inflation. And in response, the Fed will then increase, interest rates as a way to cool things down a bit, and that's kind of a normal cycle, rinse and repeat, right? And that's kind of what history has shown us. It's kind of back and forth. Well, we're in a little bit of a unique environment right now where inflation exists, but it's not due to robust growth. We've had steady growth over the past number of years, but no one would characterize it as overheated. In our view, that's because this round of inflation is a byproduct of the increased money supply, which we were just looking at. But regardless, the Fed needs to address it, and it's started to raise interest rates. Can you hear me, Thomas? Okay, sorry. So from an investor perspective, which is what this chart is talking about, the interest rates begin to rise, and attitude shift from basically more of a risk-on environment to a stance of caution. And this chart demonstrates that. You can see that typically whenever the Fed embarks on a rate tightening cycle, this newfound apprehension can cause short-term sell-offs as investors try to figure out what that's going to mean. The good news is that after instigating these heights, especially from very low levels, that in and of itself does not negatively impact the markets over the long term. Anywhere from, it's hard to tell, these are days, but if you, anywhere from 2 to 4 months after the initial rate hike from the Fed, markets have already started to recover from their initial, if you want to call them post-hike jitters, to continue to post positive returns. So overall markets get over interest rate hikes the beginning of the rate tightening cycle pretty quickly.
Awesome. Can you guys hear me?
Yep.
Okay, thank you. I had some technical difficulties, but I think we're back. Thank you, Derek. Good information. We're going to keep moving here. So global headlines, this is something I love. This is a really, really good graph. And David, I'm going to have you start us off. This kind of goes back to my point earlier on if companies can make money. There's going to be other events that will obviously maybe spook markets or make them seem unstable for whatever reason. But ultimately, we should always remember it's tied back to the companies that make up the market. So David, walk us through some of these events, what this means, how we can interpret this.
Yeah, so the visual here is meant to show that media headlines and global events can have near-term volatility implications, but usually over the long term, more often than not, the market tends to shake these off. You know, anything that doesn't change the underlying fundamentals that support the market, as you've said, Thomas, anything that doesn't really have a massive impact to the businesses and their ability to continue to be profitable is nothing more than a fleeting event. So as shown, the two in red there, it's more often than not, it's the events that do have these implications that cause a bear market. The examples would be a COVID economic shutdown and then the financial crisis. The economic shutdown, obviously, some businesses just couldn't operate, and I think, you know, I don't have the exact number, but earnings on the S&P 500, I think they fell more than 20% during that time period. So, you know, it's these types of events that are more concerning. One good example I like to point out, if you can read it there, it's in the middle of the page. It's the Brexit vote. This was one event that was constantly in the headlines daily, causing some volatility, made investors nervous. Many thought this would cause, you know, a disruption of economic cooperation among the European Union, and many thought other nations would follow suit and leave the EU, and it would be a breakdown of this this group of nations. Well, that ended up not happening. No one else, as far as I'm aware, no one else left the EU. The market soon moved on higher.
I think another good example to kind of talk to the importance of, or lack of importance of, some of these other events that are outside the financial sphere is if you a period that predates this chart, but if you go back and look at the period from 2000 to 2002, you're going to see that the market downturn at that time was really in line with not necessarily things outside of things that impact financial conditions. So everybody refers to the tech bubble. The peak of that was in March of 2000, and it started to pop when markets realized that the business models, to your point, David, of some of these businesses, they were highly unprofitable, and the market really couldn't sustain the valuations at the time. And then, of course, the slow grind, and we talked about slow grind of a bear market. Really, I mean, obviously that was a definition of one. As 9/11 happened, that created a great deal of economic uncertainty in terms of companies. We also had corporate scandals piled on top of that with the accounting issues. Enron, Arthur Andersen, Tyco, some of these other, Comcast. All these things in tandem shook people's confidence in sort of the the soundness of corporate fundamentals and financials. And then it wasn't until we finally had the Iraq War begin in beginning of 2003, and ironically, that's when the market recovered. Not because the market is fond of war, but it essentially moved some uncertainty that had been lingering for a period of time, and I guess we probably can't overlook the fact that markets at that point were so depressed that valuations became compelling. But anyway, in my personal opinion, I think that's a good example of how markets are highly influenced by global events that are mostly focused on economic perspective, less so other things, which makes sense. Obviously, markets are about
Yep. And as it relates to, I'll talk a little about Ukraine and Russia right now. That's the event. That's the headline of the day. From our view, I think we remain cautiously optimistic that the situation will be resolved without substantial detriment to the global economy. We do want to say, the direct effects from the war are likely to be somewhat minimal. I say that as it relates to GDP. So Russia and Ukraine represent less than 2% of global GDP. And so even if the war reduces Ukrainian and Russian GDP by 30% and 10% respectively, mathematically, this equates to about a 3% reduction in global GDP, so somewhat minimal. However, the secondary effects are probably what are more concerning. So the disruption of commodity markets and supply chains, considering Russia is one of the world's largest oil exporters. Let's see, what else? They're also a large supplier of natural gas, specifically to Europe. Russia and Ukraine are major agricultural exporters. And so there's a lot of reliance within the region on those countries for certain commodities. So this disruption then becomes inflationary as countries have to, as there's less supply, countries have to resource. And so the worry becomes that this is additive to the inflationary picture. However, we were already seeing some of this inflation. So as I said, we remain cautiously optimistic. As of now, GDP and earnings growth expectations remain positive. As the situation continues to progress, we may get more clarity on the duration and the exact impact this war will have. But yeah, right now, because of the GDP and earnings outlook, I guess it doesn't fully rise to a major concern for us.
Awesome. Good info, fellas. Good info. All right, let's jump into our conclusion here and just look forward to what we tab as our baseline expectations. What do we view from here? How does this look going forward?
Yeah, just to continue basically what, feed off of what David is saying here. I mean, everything he said is spot on. Our baseline expectations are, well, I don't need to read them. You can see what they are. But that notwithstanding, we do recognize that we're in a very sort of unprecedented environment, if you want to call it that. So we've essentially been in the 13-year bull run market. We've had a long run of low interest rates. The Fed balance sheets, it's almost $9 trillion. Valuations are, you could argue, historically full. It's probably a good way to put it. Inflation is rising, certainly higher than it has been in decades, at least for a short period of time here. And geopolitical risks are on the table all over the place. And David did a great job summarizing that. We also understand that the Fed's in a pretty difficult spot right now. They're trying to raise interest rates to combat a lot of this inflation, but again, that act is a de facto growth dampener, and they're trying to combat inflation without overdoing the dampening of the growth, if you want to say it that way. And this won't be easy. We don't really have any illusions that they're going to be perfectly successful in doing that. Now, we all know anything can happen, and short-term predictions are usually worthless. It's basically like trying to time the market, as we said we couldn't do earlier. But our baseline expectation for global stocks and even some bonds are going to be like that. They're going to be likely positive on balance for the calendar year this year. And the reason we think that is what we're seeing, to David's points here, there's nothing that's really causing us to materially change our underlying fundamental outlook that we're expecting about 2.5 to 3% GDP growth here in the US, even with everything else that's going on. We expected the 10-year yield to probably settle around 2.5 to 2.75%. We're getting close to the 2.5 piece already, but we don't expect that to continue to rise, at least at the rate it has been. Inflation it's been sub 2% here for a long time. We would guess, a decent guess, it would be around 4%, 4.5% for the year, 2022 calendar year. And we would expect S&P earnings growth anywhere from 8 to 10%, again, with everything going on. And that last piece here, the earnings growth from 8 to 10%, I mean, it just, again, stock markets really just pricing mechanisms centered on a couple things: earnings growth expectations that are discounted by an interest rate. And so valuation models are really simple math based on those inputs. And so if our assumptions prove even somewhat accurate, we think that neither the rising rate environment that we're in right now, nor the current events that are happening in Russia and Europe, that on their own are going to substantially disrupt markets over the year. Now, we don't expect the same types of returns that we had in the recent past to continue. And we would ask or caution investors to reduce return expectations going forward. But we don't think they should necessarily expect a deep and ongoing correction either.
Awesome. Good stuff. Let's get into Q&A. Really good stuff to David and Derek. We've got 2 questions that have come through. So as more potentially come in, we'll answer those. But as a reminder, you can send questions into the queue if you have any specific, and they'll get filtered to me, and we'll do our best to answer everything. So first question came in from an audience member. Do you all use inflation assumptions in your financial plans? Really, really good question. I can answer that. Yes, we do. And it's important that you have an inflation assumption in any financial plan that you've done. We do use inflation assumptions year over year. So we'll show an annual inflation assumption over a 30-year period if that's what we're planning for, or longer, depending on your financial plan. And our inflation assumption built in is at 2.5% per year for expenses rising. Derek, do you want to hit on where we come up to, or why we have 2.5% and where that comes from?
Well, sure. I think the first point I would point out or mention is, it used to be the long-term, or the longest historical average of inflation used to be about 3.5%, going back decades. And this most recent decade that we've just gone through is significant sort of reduced expectations on a long time frame. We've basically been sub 2% inflation over the last decade, and the 2.5 comes from, I think it's wise in the context of financial planning to use conservative numbers. So something above 2.5 versus actual 2% over the recent number of years makes a lot of sense, and it aligns very well with what the market is anticipating on a going forward basis. Just an example would be looking at 5-year forward interest rate expectations, which is what that is the market's looking out 5 years, and from that point forecasting what they think inflation will be 5 years from that time. So it's basically a 10-year outlook, and right now I think it's about 2.4%. So using 2.5 is a good number. It's something that we do look at on an ongoing basis. If we thought that inflation was going to be materially higher on a longer term basis, we would definitely modify the number as needed. But I think it's where it needs to be.
Perfect. We're getting some really good questions flowing in here. So okay, Derek, this one's for you. With the Fed balance sheet at $9 trillion, how long will it take to lower it? And what is their new normal size balance sheet, quote unquote normal? How do they lower it? What should be a standard balance sheet? How should the Fed, or how would the Fed maybe approach that?
Well, yeah, they're going to lower it by we use the word quantitative easing, when now it's called quantitative tightening. It's just, rather than buying bonds, they're going to either let them roll off or actually sell them. And so that reduces the size of the balance sheet. So, I mean, it's a great question. I don't even think the Fed knows the answer to that question. We did, if you look at what happened after the financial crisis in 2008 and 9, and the balance sheet blew at that time, like I say, blew up. It expanded. We were over $4 trillion and change for a period of time when the Fed embarked on various rounds of quantitative easing back then. It did start to moderate, and they embarked on a number of years of quantitative tightening, and they got back down to 3.5 trillion or what have you. So we have demonstrated the ability to reduce the size of the balance sheet, but it does take a long period of time. And 9 trillion is a big number. Candidly, my personal opinion on this is that the quantitative tightening, we don't know exactly what they're going to be doing on going forward basis. I think on April 6th, the most recent Fed meeting notes will come out, and they're probably going to address the magnitude of the quantitative tightening. I think the market, we're talking about what risks are. We're talking about the rising rate environment. The QT, as they call it, is probably a bigger wild card, and the market, depending on how rapid or aggressive the Fed wants to be in its QT regime, or that could have impact on the markets. We don't expect them to get too crazy with it, even if they went to $100 billion a month is selling bonds at that rate. That's perfectly sustainable, but they have a long way to go. So I don't mean to be non-responsive to the question. I just don't know how long. I don't know what the new normal is. I don't think anybody does.
Yeah, that's really good. That's a really good question. This is a great question that's coming in, and for the audience, we have gotten at least 9 to 10 questions. So if we cannot hit all of them, that's my apology, but they're coming in. So keep it up. We'll try to hit as many as we can, but they're coming in quite fast. This is a really good one. I can answer it, but I'd like you guys to add some color. If I invest in an S&P 500 fund regularly, should I buy the mentioned normal dips, or should I buy every 2 weeks? And I will start that, and fellas, I'll take some color from you. You should do it systematically on a disciplined schedule. So if it's every 2 weeks, and that's just goes in line with your personal plan or your budget, you should stick to that. The reason is it'd be great to buy the dips, but like we said earlier, it's just impossible to know when they're coming. Every day is literally a coin flip, like David had mentioned, since 1950. You might see a cluster of down days, and we mentioned that's possible. And if that falls in line with when you were going to buy, great, buy then. But don't be afraid to buy on up days just because you haven't seen a down day. Because I could go back to some of the graphs, but you might not ever see a down day to the point where we had earlier. It could go up for 6 months, and the down day you were waiting for never happened. So systematic investing, dollar cost averaging is another term for that, is definitely preferred over the long term. Guys, do you have anything to add to that?
I've in Excel, I've done this analysis before, and it is, as you said, Thomas, it's better to do it systematically and regularly. If you're just relying on buying the dips, there tends to be periods where the dip doesn't come and your money is sitting on the sidelines, and you lose out on that return with just cash sitting on the sidelines. And then the dip that does come isn't enough to make up for the loss or the benefit you would have seen. So do it systematically.
Well, I would add one other little wrinkle to that. I think absolutely systematically, but when dips do come, I accelerate it.
Yep.
Or put more in. I mean, if the market's down 10, 13%, rather than just do your normal DCA, if you can buy more.
Yeah. Buy low, sell high, right? Okay. Derek, let's start here. Derek, what are your assumptions on the speed and level of interest rate increases that will occur over the next year? And what impact on the economy will they have over the next 18 months? So speed and level over next year, potential, and then how does that impact the economy in next 12 to 18, 24 months, give or take?
All right, well, I'm gonna invite David to chime in here and see if he differs. I'll say too that, well, okay, on the first piece, consensus is that we're gonna get it, a rate hike at every meeting yet this year with 6 more at a quarter, or 25 basis points, 1/4% each, maybe a 50 basis point thrown in there. If that happened, we'd at the end of the year, we'd be around, what is that, 2.5%, maybe even 2.75% Fed funds rate by the end of the year. That's what the market's pricing in right now. I don't know that that's going to happen. I would be. It's kind of a tug of war because I think the Fed needs to do that. Frankly, you could argue that they're a little bit behind the curve on inflation, so they need to be more aggressive. The cynic in me starts to think about that we're in a political year. I don't know. I think if they did that, the market would react negatively. I think it can. We showed a chart how the market goes down on the initial rate hikes, and then starts to come back again. But that the rebound is I guess what's the word? Assuming that the economy can handle that over a period of time. I think given everything that's going on right now, if we got 6 rate hikes, the market would start to throw a little bit of a tantrum. So I guess the market's pricing in 6. I don't really think they're going to get there. If they did do 6 and the market were to get upset by that, I think we're seeing an inverted sort of the yield curve start to be a little bit cautious right now. I wouldn't, frankly, a recession at some point in the next following that is in the cards if that were to happen. I'll say one other thing though, that recessions following yield curve inversions or rate hike regimes or whatever you want to call them, they're usually 2 years down the road though. So I don't expect anything over the next 18 months. Negative reaction from that. David, am I way off base?
No, I think we're generally in the same camp there. Obviously, I think it's going to be determined the path of inflation. If inflation, makes its way lower faster, but yeah, I could definitely see the Fed backing off a bit. But if it maintains at a higher level throughout the year, I think they're going to stay on their path.
That segues perfectly into another question, which is really very similar. So where do you expect inflation to top out? And what time range do you expect for a recession to begin? How long could we expect it to maybe last? Obviously, we answered some of that, 18 to 24 months usually after a rate hike, but and I know this is a new playbook and we haven't seen any of this before, and Powell he's got a tough task ahead, but at what point do you think the Fed says, okay, we're combating inflation, it's starting to come down, and where it might top out? And then how does a recession fall into play with that and timeline? Any thoughts?
Yeah, I guess I would say that I expect current inflation to go higher yet. I don't think a number from 8.5% to 9% over the next, on a year-over-year basis, over the next few months coming into summer is going to be, off the table, just with everything we're seeing. But I do believe there'll be relief on the latter half of the year, and so if you average those things out, then that's kind of where we get to our 4.5% number. But Yeah, I think as far as the impact to I don't think that's recessionary though. I mean, that's kind of it feeds into our baseline assumptions. Even with that happening, we understand it's temporary. We were of the mind last year too. We were, you know, the transitory term from the Fed saying that inflation is transitory. There are elements that are definitely transitory, and that was the David mentioned sort of the supply chain disruption issue, some of the pent up demand thing. Those things are transitory. What's not is the money supply.
Yeah.
So that's why in our view, it's not going away, but it's not going to be recessionary unless things change from where they are now.
This is a really good one as it regards to companies. You know, we talked about if a company is profitable, those are what make up the markets. We should see markets rise over time. Question, are you saying that large companies will be able to pass on price increases to maintain their profit margin, and that the stock market will rise accordingly as an inflation hedge? So is that are large companies able to pass on those price increases to maintain profit margins and stock will rise accordingly? Is that something that you can see happening, or is that something they can do?
David, what do you have thoughts?
I mean, so far we've seen companies be able to do that. We've seen profit margin expansion. Profit margins for the S&P 500 are at a peak level. They are high right now, and that is one of the, I would say, one of the fundamental underlying components that at least we're watching, and that could be of concern, is whether they are going to be able to further pass on these cost increases to consumers. With inflation as high as it is, and if you don't have incomes keeping up with that inflation number, that leaves real incomes lower, less money for consumers to spend, and less ability to absorb those higher prices. So that great question. I mean, it is at the level of inflation we're at right now, it is kind of it is probably a tough hurdle to continue passing on those price increases. I'm sure companies will continue to do it. But if they can't, then that would certainly lead to probably some margin compression, which would be of concern.
Yeah, and I'll just add one additional thing. I mean, I think, yeah, there are limits to what they can pass on, but the question about whether stocks are in inflation, yeah, they absolutely are. I mean, you can say maybe real estate would be a little bit better one, or certain commodities, what have you, but stocks certainly are, especially industrials, materials, and financials. Those sectors have the ability more than others to do exactly what David was just talking about.
Awesome. We've got one more question. We've been able to get through most of them here. David, I'll tee this one up to you. You used the S&P 500 as a benchmark today. Do you recommend investing globally or sticking with one index?
Globally, and even within company size is how I'll put it. So the S&P 500 is focused on large cap stocks, and within the investable universe within the US, there's mid and small cap stocks as well. So definitely we recommend a global allocation. Our core strategies that we use with clients are globally focused for the added diversification benefit that you receive. So yes, internationally, as well as mid and small cap obviously at the appropriate allocations.
Yeah, it's a great question, and it's certainly a good answer, David. The other thing too that I think it's really important for individuals and consumers and families to know is that when you're in distribution phase in your portfolio, if you just have one holding in your entire portfolio, it makes it a lot more difficult to plan distributions. If you have a diverse portfolio with a wide range of holdings, you don't need to have 75 holdings. But if you own multiple funds, multiple indexes, multiple ETFs, whatever have you, multiple holdings, your ability to take from your portfolio in the distribution phase is now better suited in your hands. You have the ability to choose. You avoid sequence of returns risk. You have a lot more leverage, and that's why it's important to start investing early so that you can have more embedded gains across a diverse portfolio, so that when you are distributing, you are taking from gains across the portfolio, not just one holding. So lot to go through there. Great question. We've gone the full hour, and that was all the questions that we had come through. So awesome job, guys. Bethany, is there anything else that the audience is asking?
Nope, it looks like that's all we've had come through. Just a reminder, we will send out the recording and the presentation here for you all after the webinar. And then there will be a survey too. So if there are any additional questions that come up or any feedback that you'd like to provide, feel free to do that in the survey as well.
Great. Thank you very much, everybody. Thanks for coming in.
Thanks, everybody.
Everybody.